Three stocks to avoid June 2024. Number 1, IBM. IBM stock has soared 30% over the past year as the company positions itself as an AI winner. On the latest earnings call, management talked up bookings from generative AI and WatsonX. However, it looks like AI growth at IBM has already started to slow. Sales doubled in the fourth quarter, but in the latest quarter, growth slipped to double digits. And at $1 billion of revenue, it doesn't move the needle. In fact, AI could hurt IBM more than it helps it, since more than a third of IBM's revenue comes from consulting services, which could be at risk from new AI solutions. Total revenue for IBM is expected to grow in the mid-single digits this year, which isn't great in the context of the current artificial intelligence boom. Meanwhile, numerous acquisitions over the years have left the company with a bloated balance sheet with $60 billion of debt. IBM's revenues are still 40% below where they were in 2011. Number 2, Cara. Restaurant business Cara has been making waves with its fast and fresh Mediterranean food. The company has already opened over 300 restaurants and got up to $800 million of annual revenue. As a result, many investors see Cara as being the next Chipotle, which has been one of the best stocks on the market over the last 20 years. The problem, however, is that Cara is already being priced that way. The company has a current valuation of $10.5 billion right now, while producing just $110 million of operating cash flow, so the stock looks extremely expensive at 100 times cash flow and 290 times earnings. So even if Cara does become the next Chipotle and hits its target of 1,000 stores by 2032, an investment in the stock isn't guaranteed to produce strong returns from this price level. Number 3, Sunrun. The solar power industry is booming right now. A recent article in The Economist said that solar will be the primary source of human energy by 2040. And that $500 billion will be spent on buying and installing solar panels this year. So, an investment in residential solar company Sunrun might seem like a good choice, but in reality, solar companies like Sunrun are burning enormous amounts of cash as they build out their systems. Over the past 12 months, the company has reported $2.5 billion of negative free cash flow, and its debt balance has swelled past $8 billion, more than twice the company's market value. Sunrun thinks its debt will eventually be repaid by its customers, but exactly how that works isn't quite clear, with some analysts calling it a debt Ponzi, and Sunrun's position is made worse by higher interest rates and slowing growth. Top-line revenue is down 12% from the same time last year, putting the business in a delicate position. So that's 3 stocks to avoid in June 2024, but these are my personal opinions, not financial advice, and I hold no shares in any of these companies. Thank you for watching.